Welcome back to our financial wellness series with the CalvertHealth Foundation. My name is Bill Gaines. I've been the host for several of these educational events. And with me today, I have the pleasure of introducing Martha Reimer with Lombardo and Ayers. Martha's been also formerly Reimer and Associates, now Lombardo Ayers.
Right.
Anyhow, Martha has been a local supporter of the community for many, many years. She's been a CPA for many years as well. And we're here today just to talk a little bit about some end-of-the-year giving that can be done through something called Qualified Charitable Distributions, or we use the term QCDs as acronyms. So again, we thank you for watching today, and we're just going to have a little conversation about QCDs and just end-of-year planning.
Sure.
Martha might talk a little bit more about some other options for giving as well. As always, we always recommend you sit down with your financial advisor or your CPA or tax professional for any of these discussion points we're going to have today.
Great.
So we use the term RMD, required minimum, that's what it means, right? Required minimum distribution. When does someone have to take that RMD, Martha?
Sure. Right now, if you have an IRA, then you're required, and a 401k, you're required to take what's called the required minimum distribution. And that happens now at age 72. They've increased that age over time.
Yep.
So at age 72, so that basically says whatever's in that account, there's a calculation that every year based on the fair market value of that account at the end of the previous calendar year, you have to take it out that next year by the age 72.
Okay.
And if you don't take it out, there's a 50% penalty. So usually we try to inform our clients when they're in for their tax appointment, they're getting close to that timeline to talk to their investment advisor, find out what the balance in their account is so they can calculate what their required distribution is.
Yep.
So that is taxable income if it's coming out of their regular IRA account, and they would need to report that on their tax return in the year that they turn 72.
Okay.
So you mentioned the qualified charitable distribution. So that's something that came into law back in 2018 where they allowed you to donate that amount coming up to $100,000 to a charitable organization.
So $100,000, is that per, like if I'm married, I could give $100,000 and my wife
That's
could give
correct.
up? Oh,
you
wow.
could do $200,000 on a joint return. So you could take $200,000 out of your IRA account as long as that distribution goes directly from the investment firm directly to the charitable organization.
I was just going to ask that. So if the check comes directly to me,
Then null and void.
I'm taxed on that.
Exactly.
Otherwise, as long as it's, so check with your financial advisor because they're going to have to make sure that
it goes directly
to that organization.
And for example, CalvertHealth would be a great organization to receive one of those qualified charitable distributions. And as he said, the investment advisor could coordinate that, make sure that check gets sent out, and that does count towards that required minimum distribution. So if, let's say, your required minimum distribution is $20,000, but you still want to give up to $100,000, you can do that. And it would count for that year only. You couldn't carry it into the next year as part of your RMD. So that's a nice way. And the other benefit of that, I just want to mention, it comes up quite a bit. Under your Medicare premiums, it's based on your total adjusted gross income. So this is a way that you can reduce your taxable income because, again, that qualified charitable distribution will be not taxable on your income tax return. And therefore, it reduces your total adjusted gross income. Your Medicare premiums are based on your AGI, and they're fairly low thresholds. So a lot of you know on your Social Security check, your Medicare premium comes out of there, and sometimes I get calls saying, Martha, why did my Medicare premium all of a sudden go up? And that's because their income has gone up over the threshold. And we're seeing quite a bit of that. So a lot of people do plan every year, say, hey, how can I get my adjusted gross income down a little bit so I'm not forced with this Medicare penalty from my premiums?
Good old IRMA, right? Isn't it called IRMA?
Yeah, exactly.
Income related, yeah.
Yes.
Yeah.
So it's again, a very good way also to save some additional dollars in your cost of your Medicare premium. So we like that as another benefit of that deduction. The other thing that comes up quite a bit is some of you may know the standard deduction went up significantly in 2018.
Okay.
And now the standard deduction, I wrote down the 2023 amounts for us. It's actually on a joint return for somebody over 65 is $31,400. That's a very large standard deduction. So if you think about that, you're limited to $10,000 for taxes. So that gets you $21,400 that you pretty much would use for charitable contributions.
Okay.
So if you take the standard deduction and say, gee, I'm going to go ahead and do, $30,000, $40,000 through my IRA to the charity, I can still take that full standard deduction.
Okay.
So it's becoming very difficult for folks to itemize.
That's important, yeah.
Because it's the standard deduction is so high. So it's good news, bad news. So I've got a lot of folks that come in, maybe given a few thousand away to charity, and they're excited about that and want to take a deduction. And I tell them, I'm sorry, the standard deduction is much higher.
Yeah, that's important.
And it's about 87% of folks now are taking the standard deduction.
87%?
87% of the population is taking the standard. And that keeps going up every year. So we see that, I don't know if it'll increase over time.
Sure.
Because obviously the largest deduction is mortgage interest. And so folks that are a little bit older sometimes don't have mortgages anymore, and they're not getting that deduction. So standard deduction probably for our senior population is much more prevalent because they don't have anything else other than charity.
Okay.
So the qualified charitable distribution is actually a very good way to reduce your total income, but also give to the charity and maintain a fairly high standard.
I'm going to have a question on that. Just wanted to clarify. So if someone has, they might have a smaller IRA balance, and maybe they only have $10,000 RMD for that particular year, but they would like to give $2,000 or $3,000 to their, to the hospital or to Boy Scouts of America, whatever it might be, church. So they could potentially do that and then take the difference, the $2,000 or whatever?
That's correct. They don't have to give it all away. So again, as you said, if the required distribution is $10,000, they only want to give $2,000 away, they'd notify their broker and say, hey, can you go ahead and send $2,000 over to the hospital foundation for me, and then just send me a check for the balance.
Okay.
And then every year they'll get that 1099-R, as they have been getting in the past, and it'll show the total amount of the distribution, the $10,000, and it'll show $10,000 as taxable. But they'll have to notify their accountant, or if they're preparing their own return, they have to take that deduction on there for the charitable piece.
Gotcha.
Okay, it is
that
not.
$2,000 doesn't get taxed.
It does not get taxed. But unfortunately, it's still on the 1099.
Yes.
So we get a lot of those questions from our clients saying, "Hey, I gave away all of my IRA last year to the hospital foundation, but why is my 1099 still say all of it's taxable?"
Yep.
They have to notify us. We attach the documentation.
Okay.
Because again, you still have to show the IRS the documentation for that charitable donation. So the hospital would send their foundation receipt to you. You hang on to that, give me a copy, and that's your documentation.
Perfect.
Sometimes the 1099s are confusing, but we would handle that on the return.
Good. So there's some other ways that I know people can give, and we have obviously some that are a little bit more complex, and for the right client, somebody a little bit higher net worth, that sort of thing. You want to talk a little bit about that as well?
Certainly, estate planning is also a good thing. So we've got folks that have some resources that they're thinking about a charity that they'd like to give their money to. So certainly in your will, you can leave money to the foundation. You could leave a nice gift in your will, and that would come out. The estate tax limit is high now. That went up, so now it's over. Let's see what my limit here is. $12.92 million per person. Per person. So it's a lot. So almost $13 million per person. So unless we all win the lottery,
that means we could give away basically
that amount.
Up to $26 million if myself
taxes.
And my spouse. Yeah.
Right. So as the old saying used to be, unless we win this big lottery coming up, we probably don't have to worry about that limit. So what that means is, as long as your total estate for you individually is below that threshold, there is no federal estate taxes.
Correct.
But I need to warn you, Maryland is still a $5 million limit. Okay, so Maryland, I've got some folks thinking, gee, I'm free and clear, I'm fine. Maybe they have a total estate higher than that. Certainly on a joint return, maybe husband and wife also as well. So there's some planning there.
Sure.
So I always recommend take a minute, talk to your investment advisor, your CPA, even your attorney, estate planning attorney, to say, hey, do I need to do a little bit more planning there? So certainly as a direct, something in your will directly to the hospital would be fine.
Bequest.
You can also set up a charitable remainder trust, and you can do that during your lifetime. So this is another tool that I've had several clients that have done that, where they've taken a portion of their assets and they want to go ahead and give it to the charity. So it doesn't actually show up at the charity until they pass away. But during that time, they are actually earning the income on that gift. And the year they set that trust up, so let's say they put $500,000 in a charitable remainder trust, they get a charitable donation that year for $500,000.
Very nice.
So that's a way that the hospital could talk to folks that want to do some planning, that maybe have some assets that aren't ready. They still need some income.
Yep.
This way that gives them income during their lifetime, and then upon their passing, the hospital would get the gift. So that's a really great way. The other thing I really I see more and more of is the donor advised funds. This is beneficial for a lot of folks who maybe are under that 70 and a half age.
Yep.
Because a lot of folks come to me, they're retired, they want to start giving some money away, but they can't use the qualified charitable distribution to do that. So they could use this donor advised fund option, and they could go to you as their advisor and say, I'm going to put $200,000 into an account.
Okay.
It is a restricted account, so once you give that up, you can't get access to that money. But that year, you get a $200,000 charitable contribution. So that it puts all of the charity in 1 year. You get a full deduction that year. Helps you on your taxes. So I've got folks that come to me and say, hey, G. Martha, I just sold a piece of property. I've got $1 million profit on there. I'm going to have a huge tax bill. Is there anything I can do, give some money away maybe this year? And this is a way to do that. So they could put the money in at one time. And then the nice thing about that, they could call you up every year and say, hey, don't forget the hospital. I want to give them another $10,000 next year. And maybe for the next 5 years, I want to give them $10,000. And you can give that over time through this trust.
And it could be multiple
beneficiaries.
Yeah.
You could do as many charitable organizations as you would like.
Hospital, hospice, whatever.
Exactly.
Yep.
And there'd be 501c3 organizations. Qualified organizations. It can't be a private foundation or limited. You cannot do that.
Okay.
That's a big benefit. And I like that because it gives folks in time to plan, and then they could spread those donations over time, but get that one bump up.
Okay.
So that's another good way. And the other one I thought about, which we get calls on, I'm sure you do too, is appreciable stock. So guess what? We have AT&T stock we bought back in 1970, and it's got a $2 basis. Wow, my capital gains on that is huge.
Huge, yeah.
What do I want to do with that? Maybe that's a good gift. And as you give that away, you get the charitable contribution for the fair market value of that gift.
That's right.
And
the organization
then
gets
you
to
don't have
take
to pay tax on that.
Yep.
Okay. So, I'm sure there's quite a few folks that have things like that
We've
that are
done
sitting
that.
out there. And you've done that. I've seen that come through quite a bit. Where folks have been giving stock away as charitable contributions.
Good. I'm glad you brought that up because that is important. It's not as well known, if you will, out there. So.
And a lot of times that, like I said, folks come to me and they have to sell. They've got this huge appreciable stock there, and they just don't really want to pay the tax on it in time. And you don't want to tell them in order to get the tax wiped away that have to pass away with it, but that unfortunately is the only way you can reduce that gain.
That's right.
Is to make it part of your estate.
That's right.
So if they want to give it away during their lifetime, that's a great way to do that.
Great. One more thing I'll piggyback on right before we end this session is the hospital has been, or the foundation, if you will, we have a website that clients can go to, or consumers, I should say, can go to, where they can actually look at something called a charitable gift annuity. So we have been approved by the state to be able to do annuities, gift annuities, charitable gift annuities. And I say piggyback because Melissa from the hospital foundation has, her and I did a video a couple weeks back.
Great.
And we just kind of talked a little bit about that and some of the examples of where they can gift that money and receive an income stream from that as well. So
similar
to the
very
charitable.
similar charitable remainder trust. So that gives them options to get some income during their lifetime.
And
for a lot of folks, they're concerned about that. It's difficult to give assets up if they don't know they have an income stream.
So if they give $10,000, it's called a charitable gift annuity. They also get that tax deduction.
That's correct.
If they're obviously check with your tax professional before you do such a thing. And that's important.
Yeah,
so
that's another good way. So,
Good.
So there are some options, and in the IRS tax code, as you might recall, this past year we all got a little bit of deduction on the return for charitable contributions if you took the standard deduction.
That's right.
But that goes away. So,
Okay.
so charitable donations, if you take the standard deduction, you really don't get a deduction for if
And
it's
that's-
not above the standard amount.
Goes away for 2022 is what you're saying.
That's correct.
Okay,
Yeah,
gotcha.
for this following of the year. So.
Well, thanks for clarifying.
So, as I said, a lot of folks are coming to me, concerned that they didn't get a donation
Gotcha.
deduction for their donation. So
Okay.
that, you know, finding another way to do that is a great way, either through some of these options through the qualified charitable distribution if they're old enough, or certain set up of donor advised funds is another way to do that. So give them that ability to do that.
Great.
Yeah.
Well, Martha, we certainly appreciate
Not
your
a problem.
time today
Not a
and
problem.
always being supportive. And
Sure.
we thank everyone for watching us, and we hope
Absolutely.
that everyone has a great holiday season.
Thank you
Thank
so
you.
much.